Hello, and welcome to Navigating Seasonal Cycles with Jake Bernstein. The information provided in this episode is for educational purposes only. There is a risk of loss in all trading and investing. The results shown are hypothetical and should not be construed as investment advice. And now, over to you, Jake.
So welcome to my seasonal podcast. This is Jake Bernstein, October 29th. It's 2:31 p.m. where I am in Santa Cruz Mountains, California. I want to thank you all for your great letters of support, your emails, your questions, and of course, Dan Muse and Bill, who helped me with this immeasurably, make it look professional and make me look good. So we've been talking about seasonals in its various forms, and we're going to get a little deeper into the woods today because I realize there are here traders from all aspects of experience, from the most beginners to the most advanced. I want to try and keep everyone happy with information that is sensible and usable within the context of your experience. So today we're going to talk about the best seasonal trade of the year, which I'm going to show you, and then we're going to talk a little bit about spreads or pairs trades. If you find it boring, I apologize to you, but it's an important concept. And of course, it's all related to making money, but it's the beauty of the concept that's most interesting to me. Because when we talk about cycles, we can talk about them, as I said in the past, pragmatically. In other words, how do we use them for making money? Or conceptually as a great concept. And the beauty of that concept, as Edward R. Dewey applied it to his methodologies. So we're going to begin with what I call the best trade of the year. Now you may have a different interpretation of what I mean by that, but I'm going to show it to you anyway. And by the way, as long as we're here on Seasonal Trader, let me get my pointer here and show you something. If you'd like more information on seasonals, strongly suggest, hold on, let me get my pointer here, that you go to seasonaltrader.com and read the sign up for the free trial, but most important, watch this video. It will help you immeasurably understand what I've been explaining to you here, as well as other concepts that I've yet to talk about. What I wanted to talk about specifically today was what I call the best trade of the year. I'm going to log in and show it to you. Let me get my cursor back. Here we go. And log in. And I'm going to go to seasonal trades for stocks, like so. And I'm going to come down to the S&P. And please understand, we're talking here about a process. And even though what I'm about to show you is very high probability in terms of the past, even at 85% probability over the course of many years, it's still not 100%. And that 15% can make a big difference. It's the 15% of the time the trades are wrong that separates the winners from the losers. So understand the concept and embrace the concept, but also embrace the concept of risk, because this is what it's all about. So I'm going to go to the S&P 500. I'm going to go to the month of October. Why October? Because as I've shown you in previous recordings, October is the month of the year where seasonal moves to the upside begin very reliably through October, November, and December. I'm going to do a simple search, and I'm going to ask the question, are there any trades that have been right at least 80% of the time that require a risk of no more than 15%? I realize that 15% may be a lot for some people, and it certainly is, but we want to give the computer leeway to find what it finds, and then we can fine-tune it. So here's the marching orders, and we're going to set it loose on trillions of data points and see what we get. And here's what we get. Computer says buying S&P 500, end of day, October the 27th, getting out end of day, January the 13th, with a 12% risk, has been right 85.9% of the time over the course of many years. What does that mean, being right? It means that the closing price on January the 13th or the next business day, if the market is closed, has been higher than the closing price October the 27th without a closing 12% below entry 85.9% of the time, which is very impressive. Let us look at the history. Here we go. And this covers 64 years. In and of itself, any methodology, any cyclical phenomenon that has been right 64% of the time over the course of many years with 9 losses is very impressive statistically. Let's explore it a little bit further. And here we go. Every year, going back many years. And this is what it looks like. Now, admittedly, it's not perfect, but it is a very significant development. And considering that over the last 64 years, we have had liberal governments, conservative governments, several wars, inflation, disinflation, all sorts of politics, skirmishes, and so forth. This is quite impressive. But remember, even though it's 85%, 85% is not, and I stress this very importantly, not 100%. Therefore, what we need to do is manage this trade. What I'd like to do is this. I'd like to look at the percent average profit right over here, which is 5.98. I take the closing price on the date of entry, and I take this as my first target. So if I enter on the close of trading October the 27th, I will add 5.98% to the entry price, and that becomes my first target. At my first target, I take risk off the table. In other words, I liquidate a part of my position, so now I can play with the house's money, so to speak, and continue to hold that position for the bigger move, because it's very possible this target may be achieved in a matter of days, depending on market conditions. But the most important thing I'd like to inform you of is this. There is nothing here that's poetic. It's all prosaic, by which I mean it's factual. We don't look at inflation, deflation. We don't look at geopolitics. We don't look at who's winning the war or losing the war in Ukraine or the Middle East or anything. It's a simple procedure without regard to any fundamental statistics. Now, let me show you something else. Let us go back. And let's say that we wanted to do some further massaging or exploration of the data. And remember, think of all of this in the context of seasonality, because that's what it really is. It's seasonality, which, as I said before, is a cycle. So the cycle repeats and repeats and repeats and repeats. In this case, this cycle repeats 85.9% of the time. But assume that you're like many investors. You don't have the ability to sit tight on a profit. You don't have the ability to maximize a profit. You see that profit and all you want to do is get out. Can we ask the computer to help us with that problem? Sure, let me show you what we do. And we say, let's return to search. And let's put some guardrails on this and say, do you have anything that happens in October that is less risky? Let's say more comfortable with 5% risk. I simply ask the question, and I get the answer. And the answer says, no. What the heck does that mean? It means very simply, if you are unwilling to take at least 15% risk on this trade, it won't work for you. So let's say what you can do at 10%. That's easily done. Remember, the computer works for us. We can choose whatever we want. If the data is there, it's there. If it's not, it's not. We can't argue with the computer. We shouldn't. Let's ask the question. Aha! Now, by risking only 10% stop, we get a trade that's 84% accurate. Very similar entry dates and exit dates. We're only risking 9% stop. And what's going to happen is we won't make as much profit. But that's okay. Let's cut this down because this is still a long period of time for most people. So let's go back to the search and say, give me the same information that I want to get out of my trade quickly because I'm a weak trader. I can't stay with my profits too long. So let me out within 25 days. Is that possible? Sure. And remember, we are not creating new data. We're simply using data that's already there. So let's do a search. The computer says we're too demanding. No problem. Let's do this. Let's try 35 days. So what we're doing here is loosely considered to be research. 35%. 35 days. And here we go. Well, computer is not happy. It's saying we're asking unreasonable things. Well, let's do this. Let's get real unreasonable and ask the question, is it possible we can do this in November and December as well and do a big search of the entire database? Sure we can. And by the way, with AI, this is going to be even easier and more specific. So here we go. Let's do the search. Now the computer is really not happy. So what's it saying? We need to be willing to risk more. So let's up this to 12%. Here we go. So now you see how the sausage is made. And is there anything there? No. Well, that's very interesting. We're learning so much. Let's make sure that we've got the S&P check marked. Here we go. And by the way, what you're seeing here is unrehearsed. Yes, it is check marked. So let's come back here and say, let's go back to the original 15%. And what's it saying to us now? Here we go. Now we've got a real problem, don't we? What have we done? Well, we've only changed this right over here. So let's come back to this and eliminate it entirely and put no collars on here. And let's eliminate this too as well. Here we go. And what do we get? There's original work has come back. And it requires us to be in this trade for a long time. So what do we know up front? We know up front we need to give it more time. We need to give it more room in terms of the stop loss. And if we try and mess around with it too much, we will have broken a beautiful cycle and not used it in the right way. Now let's do this. Let's go back to the search. And let's do it differently. Let's simply ask the question for the month of November. And we'll ask the question again with no stop, no target, nothing. Just give me all of your raw data. And what do you have for November? Aha! Our best rate is at 81%, and it's November the 20th through January the 3rd. And here's the history again. And then I'm going to show you one more thing you might be interested in before we go on to the dig deep into the subject. So here we go. A little bit of volatile in the last 10 years or so, but still nonetheless very impressive. So research with this if you want to. I think you'll find some interesting things. And by the way, let's just come back to the search. Just one moment, please. You can ask this question of something else. In other words, let me show you. Let's go to seasonal trades for futures. One moment. So now we're in futures. There's been a lot of interest in gold lately. I'm interested in what gold's going to do through the end of the year. So I'm going to click gold. And we are now in close enough for November. So I'm going to do some searching on November trades and December trades in gold. Like so. And ask the question, is there anything out there? Let's look. Indeed there is. And at the top of the list, we have February gold on a very short-term trade, the 77% win. And let's look at the history. So we're looking at almost half a century of trades, 48 years of history. And here's the results right over here. And look at that. So you'll notice what's been happening the last decade or so, steadily increasing. So it appears that if this process repeats, we should have a very good November, December on the upside if you're bullish. Now let's get into the next subject. Many of you may be familiar with what's called a pairs trade. And I don't mean P-E-A-R-S, I mean P-A-I-R-S. A pairs trade would be, for example, buying Federal Express, selling short UPS. You're making money on the difference between the two, because in all probability, one of those trades will lose money, one of those trades will make money. You want to make more money on the one that you're making money on than you lose on the one that you're losing. It's very simple. Why would someone do a pairs trade? They would do a pairs trade because they may feel very strongly that one particular company is going up. They've got good earnings, but they can see a disaster coming in another area, and they can do it that way as well. Going short the one, going long the other, and they can do that with options and spreads as well. So these patterns of expansion and contraction of one and expansion and contraction of the other are very important. In other words, UPS may go up while Federal Express goes down. That would be the ideal situation for the spread trader or the pairs trader. However, in futures, which we have talked about very little, spread trading is very, very effective. And it has a life of its own cyclically. And I'm going to show you some things that are truly amazing. In futures, we call it spreads. So for example, you could be long July corn, short December corn. It's a very popular spread. What would make that spread work? Well, let's say that there was a harvest problem and the corn couldn't be harvested or it was damaged. That would cause the July corn futures to go up. The December futures, in most cases, the corn hasn't even been planted yet. So the nearby corn would go up relative to the deferred corn, and the spread would work. But the thing that's interesting about spreads in particular is this. The vast majority of future spreads are traded by professional traders. The average trader doesn't understand the concept. The average trader doesn't even want to take the chance of being short one and long the other. But in terms of margin, it is one of the lowest margin things that you can do. So for example, a $200 margin on a corn spread might turn in a profit of about $1,000. So the leverage is really huge and the risk is relatively small. I want to show you something in terms of seasonality with spreads that blows me away. So let's go forward here and return to the search like so. And let's go to seasonal trades, US spread trades, right over here. So I'm going to pick a market like copper. And I'm going to ask the question, Is there anything for the entire year in copper spreads that has been right at least 70% of the time? Now remember what I'm asking the computer to do. Find me a situation where one copper contract has gone up relative to the other, or in other words, the spread has widened out. Because if, for example, let's say that one contract is at 50, the other contract is at 70. You buy the one that's at 70, you sell short the one that's at 50. That spread is 20 points. If the spread moves to 60 points, to 30 points or 40 points, you're making money. Because what you're losing on one, you're making more on the other. That's the concept of the spread. And I don't expect you to understand it if you've never heard it before, but spend some time with it, and I think you'll find it fascinating, especially what I'm going to show you shortly. So we're going to ask for spreads in copper, and let's do a search. Computer says that if you bought December copper and sold short September copper on April 21st and waited until August 24th, without a stop, your average profit would have been, you would have been right 76.9% of the time. Your average profit would have been $1.49 in copper, which is not a lot of money, but considering the spread costs virtually nothing to do, it's very effective. Let's do it in a little more organized fashion. We know, for example, that spread relationships in the grain markets are very effective because remember, these relationships can be determined based on weather. In other words, weather affects these spreads. I'm going to go to soybeans, like so, and ask the question, have there been any spread relationships in soybeans that are predictable and reliable from a seasonal standpoint? Let's look. I'm looking for 70% probability at least. And the computer has definitely found some with 76.9% probability, and they only last a few days. Quite impressive. Let's look at the history. The 65-year history, and these are the results at the bottom of the screen. Now you can determine on your own if you like the looks of this. I personally don't. I don't like to see these big losses. I don't like to see a decreasing equity curve. But again, you can do the research on your own and determine that for yourself. But what I want to show you is even more impressive. Let's go back to the search. Now I realize that trading commodities is not for most people, but we do need to bring this to your attention because it's very valuable information. I'm going to go back to return to search. And I'm going to go to a market that very few people have traded unless they're futures traders. And that's the lean hog market. Lean hogs, right here. I'm going to show you something that's truly remarkable. And please take it in stride. I'm not trying to encourage you to trade futures, but with a record like this, it's truly phenomenal. To at least appreciate the fact that this exists is very important. What am I talking about? I'm going to select all months like so, and I'm going to ask the question, are there any spread trades in lean hogs that have been right 70% of the time or more? And before I show that to you, I want you to remember this. Margin is very important. In futures trading, the margin is usually very low compared to what you're controlling, which is why the leverage is so high. Many years, it was possible to do a lean hog spread for $400. Bear that in mind, because in some cases, the profitability of those spreads was 5 or 6 times the required margin. So let's take a look. Is there anything that fits our bill? Computer says that there's been one trade, long June hogs, short April hogs, with 88% accuracy. Let's take a look at it. And by the way, the average profit has been 245 points. In the lean hog market, 245 points is 2.45 times $400, or roughly speaking, $900 to $1,000 on a margin of virtually nil. But look at the accuracy. Here's the history. Going all the way back to the start of trading in hog futures 54 years ago. Here are the results. Right here. And I find this to be quite remarkable. Certainly it's taken some losses, but you'll notice the average profit per trade is much higher than the average loss per trade. Average profit per trade is 2.45 points, but given the fact that there's been only 6 losses, it's quite impressive. Now, let's go back, and I'll show you something else. Let's say that this holding period, November 24th through April the 3rd, is too long for you. You can't stand that kind of length of trade. You want something shorter term. All we need to do is go back and rerun the search and say, I don't want to be in this trade for more than 60 days. Let's make it 50. Like so. Does that ruin the results? Let's find out. Here we go. Does not ruin the results, and here's a relatively brief one for 1 month. December 2nd through January the 8th with almost 80% accuracy. And here are the results. Right over here. And we're talking 54 years of history. Here we go. So it's all up to you. Determine what you want to do and do a little bit of research. But by all means, follow through. Let's do one more thing. Let's go back to this trade that we just looked at. Let's look at the seasonal chart. It takes a moment to post because there's a lot of data to look at. I can hear the hogs howling. Here we go. So this trade encompasses this period of time right over here from late November until mid-January. Let's do one more thing before we call it a day. Let's come back and do a search. Seasonal trades, US stock trades. And let's come to where we are right now on the S&P. Just bear with me. Here we go. And let's see what's in store for us in November. And you'll notice I'm putting no guardrails on it. I'm just saying, give me everything you have in November. Here we go. And it comes up with November the 20th through January the 3rd with 81% probability. And we did not look at the equity curve. I'm sorry, we did not look at the seasonal curve there. So let's take a look at the seasonal. Here we go. So this is what we're looking at right over here. Beginning in about 2 weeks. We will see how that turns out. And one more thing I want to show you. If I click on this area right over here, it will bring up the daily chart. Let me show you what I mean. Hang on 1 second, please. And here it is. Let's bring it into view. So this is what November looks like. And again, I do tune in on this area right over here from about November the 20th through November the 29th is a period of high probability to the upside. Let's do one more thing before we call it a day. I've had a lot of questions about the meaning of some of the metrics, so let's explain those. Let's go back to seasonal trades. In fact, let's return to the chart. One moment. And let's go back to here. And let's explain these metrics. Entry date. Entry is at the end of the day. Exit date. Exit is at the end of the day. The stop loss is a closing stop. In other words, the stock must close below by that amount. And when I say close below, I mean close below the entry price. The PL ratio. If you added up all the winning trades and divided them by the sum total of the losing trades, your ratio would be approximately 4-1 in favor of the winning trades. Percent win. The comparison between the price on the exit date and the price on the entry date. 81% means 81% of the time the price is closed higher on the exit date than it did on the entry date. Average profit in points, average loss in points. Average profit in percent, average loss in percent. Max wins means it's had 18 consecutive winning trades, which is very impressive. Max upswing. During those 18 consecutive trades, this has been the number of points that have been accumulated in a series of uninterrupted profits. Max drawdown. The maximum consecutive losses added together. Growth. We'd like to look at the trade now compared to 15 years ago. Let me show you what I mean. If we look at the trade and ask the question, has it continued to gain? Is it at its highest point in history as of the last trade? The answer is yes. So therefore the growth would be positive. If it was at this point, the growth would be negative. Let's go back to the search feature and do one more for you. Let's go to return to search. And let's talk about one of my favorites, 3M. Is there a trade coming in 3M in December or November? Let's find it. I'm going to leave it open. Find whatever you want. And here you go. So the top trade is right over here. November the 1st to November the 5th. Short-term trade. Let's see how it turns out. So if you have any questions for me, please don't hesitate to write. I'll be glad to answer them for you. And remember, when we look at seasonality, we look at a cycle that occurs within the course of a year. So for example, from January 15th through March 15th, seasonal period of time, we look at that as one cycle, and we look at the specific entries and exits during that period of time. Thank you for being here. If you have any further questions, please get in touch.